Welcome to the Smart AI Accounting Podcast. I'm Martin, and it's brilliant to have you with us for the start of our Directors Business Tax Planning series. If you're a UK limited company director, whether you're running a small creative studio, a trade-based business, or a consultancy, this series is designed to give you clarity, confidence, and practical strategies you can use straight away. Remember, we publish new episodes every Friday, so if you want to stay ahead of the game, make sure you hit subscribe so you don't miss any of the strategies we're breaking down over the coming weeks.
I love that we're jumping straight into directors, because directors are the people who are expected to know everything, but no one ever teaches them anything. They set up the company, open a bank account, and suddenly they're meant to understand corporation tax, PAYE, dividends, VAT, expenses, the whole lot. And it hits them like a wave.
It really does. And the biggest shock for most new directors is that their company becomes a separate legal person. It sounds simple, but it's the bit that changes everything. Money in the company is not your money. Not until you extract it correctly. Once directors understand that separation, the rest of the rules start making sense. So, in this episode, we're focusing on the basics, how directors should think about paying themselves, how to balance salary and dividends, what counts as a genuine business expense, and how timing plays a bigger role than most people realize.
Before we dive in, let me ask you the question new directors always ask. Where do I start? If you had to give one piece of advice to someone who became a director last week, what would you tell them?
I'd say build a simple structure early. People think tax planning is about clever tricks. It's not. It's about having a predictable framework so you're not guessing. Your salary, your dividends, your expenses, your cash flow, all of it falls into place once the structure is clear.
You mentioned salary and dividends. That's probably the biggest topic directors ask about, right?
Yes, because it's the heart of director tax planning. And the rules change slightly every tax year, which confuses things further. But the concept doesn't change. Salary is income through payroll. Dividends are distributions of profit after corporation tax. And they both play different roles.
Break it down for us.
Sure. A salary counts as a company expense. That means it reduces your profit and therefore reduces your corporation tax. Dividends do not reduce corporation tax. They come out of profit after tax has been calculated. Salary can trigger national insurance. Dividends do not trigger NIC. Salary gives you qualifying years for the state pension. Dividends don't. So you can already see why a blend of the two works so well.
And the blend gives the director the best bits of each.
Exactly. A modest salary keeps NIC low, but still counts towards your pension record. Dividends top up your income efficiently when the company's profits allow.
And that's the key point. When the profits allow.
Yes. Dividends are not guaranteed. They're not automatic. The company must have retained profit available. And the decision has to be documented properly with board minutes and dividend vouchers.
A lot of small business owners don't realize they need that paperwork.
They don't, but it's essential. HMRC expects an audit trail. It doesn't need to be complicated, but it needs to exist. And this is where directors can start getting into trouble, not through bad intentions, but through lack of structure, which leads us nicely to expenses.
Yes. People always want to know what they can and can't claim.
They do. The rule is simple. An expense must be wholly and exclusively for business. That doesn't mean zero personal benefit, but the main purpose must be business-related. Software, likely allowable. Equipment you use for work, likely allowable. Meals out with no business purpose? Probably not. Directors sometimes think the line moves because they own the company. It doesn't. The rules stay the same.
And if someone underclaims, they lose out. If they overclaim, they risk issues. So the middle ground, the sensible ground, is the sweet spot.
Exactly. Once directors understand expenses, the next pillar is timing. And timing matters far more than people realize.
Talk about that, because timing is the hidden problem directors don't see.
Yes. There are 3 different timelines directors must understand: the company's financial year, the director's personal tax year, and the cash flow pattern of the business. These timelines influence each other. For example, you might take dividends in March, but if your company year-end is September, those dividends fall into a completely different accounting period. Or your company might show profit on paper, but not have enough cash to pay a dividend safely. You can only plan well if you're aware of all 3 timelines.
Which is why directors who review their numbers quarterly make better decisions than those who wait until year-end.
Exactly, because they know where the business stands. This is a good moment to bring in the idea of profit extraction. Some directors think taking out everything the company earns is good planning. It's not. Keeping money in the business when you can afford to do so, that's where long-term strength comes from. But we'll go deeper into long-term planning in part 3. For now, let's stick with the fundamentals.
So, if you had to summarize the core of part 1, what would it be?
3 essentials. First, treat the company as a separate legal body. Second, build a simple structure: salary, dividends, expenses, timing. Third, don't leave decisions till the last minute. Look at your numbers regularly.
And once the basics are understood, directors can start to look at case studies to see how it applies in real life.
Exactly, and that's where part 2 comes in. Part 2 is all about practical examples. 2 real-world directors in 2 very different industries facing 2 very different tax planning challenges.
We've got Sarah, our service-based director, and James, our trade-based director, and I love that they show 2 very different rhythms of business.
Yes, and both examples highlight why there isn't a single perfect strategy. The principles stay the same, but how you use them differs depending on your industry, cash flow, and long-term goals.
Well, that brings us nicely to the end of part 1. This has been the foundation, the calm before the deeper dive.
Exactly. So to everyone listening, we'll continue straight into the real-life scenarios in part 2, so this is a good moment to pause. We'll see you in part 2.
Welcome to part 2 of our Director's Business Tax Planning episode. If you're just finishing part 1, you'll know we laid the foundation: salary, dividends, expenses, timing, and the importance of treating your company as a separate legal body. Now, in part 2, we're stepping into real-world examples. 2 directors running 2 very different types of businesses facing 2 completely different tax planning challenges. And this is where the ideas really start to come alive.
These case studies help people relate, don't they? It's one thing to hear the principles, but it's another to see them in an actual scenario and think, oh, that's me. That's how my business works.
Exactly. So let's start with the first example, a service-based business. Meet Sarah. She owns Bright Design Studio. She's one of those incredibly talented creatives who produces beautiful work, but like so many in the creative sector, the financial side isn't her comfort zone. She'd been trading for around 18 months before she found us.
And I remember you saying she was just paying herself whatever she needed each month. No system, no structure, just dipping in and out.
That's it. Some months she'd pay herself £500, some months £2,000. Not because of a plan, just reacting to whatever felt right at the time. She had around £5,000 coming into the company, about £1,000 in typical expenses, leaving roughly £4,000 of profit available most months. But because she wasn't using a structured approach, she always felt uncertain. Was she taking too much? Was she taking too little? Was she saving enough for tax? She simply didn't know.
And that uncertainty creates stress. It's not the tax itself, it's the not knowing.
You're absolutely right. The unknown is what drains directors. So, the first thing we did was give Sarah a predictable pay structure, something she could rely on even when her creative workload went up and down.
That was the modest salary at the NIC threshold, wasn't it?
Yes, we set her salary just high enough to count as a qualifying year for the state pension, but low enough to avoid employee NIC. That saved her money personally and reduced her corporation tax because salary is an allowable deduction. Then we scheduled dividend reviews every quarter. This meant she no longer guessed. Every 3 months, we reviewed her numbers, checked retained profit, and declared dividends safely.
And I imagine that immediately gave her more peace of mind.
It did. She told me it was the first time she understood her own finances. Instead of thinking, can I take this money? She was thinking, what does the business allow me to take based on real numbers? We then looked at her expenses. Designers often pay for tools from their personal accounts because it feels easier. Adobe, Canva Pro, training courses, an iPad, all of these were business expenses, but she'd been funding them personally.
And once you moved those into the company, that lowered her profit and lowered her corporation tax bill.
Exactly. But more importantly, it aligned her business spending with reality. Everything the business genuinely needed was now part of the business. She wasn't subsidizing her company with her personal money anymore.
I like that you always remind directors that tax planning isn't just about minimizing tax. It's about reflecting the true cost of running the business.
Yes, and that's something people often overlook. You don't claim an expense to save tax. You claim it because it belongs in the business and paints an accurate financial picture. So, Sarah's first year using her new system went smoothly. She didn't get any tax shocks, her cash flow became more consistent, and she started building a small reserve in the company.
And that reserve became the foundation for her next stage of growth.
Exactly. She wanted to hire a part-time assistant, and she wouldn't have had the confidence to do that without structure. That's Sarah, a straightforward service-based business with predictable income but poor structure, now transformed. Now let's move to a completely different world, the trade sector.
Oh yes, Apex Builders Limited. And this is where the conversation gets interesting because trade-based businesses behave very differently.
Yes, they do. Meet James. He'd been running his building company for about 3 years. Unlike Sarah's business, where costs were consistent and relatively low, James's costs were volatile. One month he'd spend £10,000 on materials, the next only £2,000. Some months involved subcontractor payments, tool purchases, or equipment hire, and he often waited weeks for clients to pay invoices.
So his business rhythm was unpredictable.
Exactly, and because it was unpredictable, his approach to paying himself wasn't helping. He was taking only dividends, no salary at all, because he'd heard it was more tax efficient.
And that's the trap many directors fall into. They hear something secondhand and apply it without context.
Yes, and while dividends can be efficient, they're not always practical for businesses with heavy or irregular costs. They don't reduce corporation tax, they rely on retained profit, and they don't help with cash flow planning. So, we restructured his approach. We introduced a modest salary, lower than Sarah's because his business needed more working capital, and we created something we call a profit clearance point.
Talk us through that.
A profit clearance point is a scheduled moment where you sit down, look at the actual retained profit, factor in liabilities like VAT, corporation tax, and any big upcoming costs, and only then decide what dividends can be safely paid. For James, we did this quarterly. No more guessing, no more taking money prematurely, and no more worrying that he'd left himself short for materials or subcontractors.
And I imagine his cash flow stabilized pretty quickly.
It did. Within 2 quarters, he told us he felt more in control than he had since starting the business. His corporation tax forecasting improved, he stopped draining the business when invoices were delayed, and because he now had a salary element, he reduced corporation tax slightly and improved his personal tax situation.
This is what I find so fascinating. 2 completely different businesses, 2 completely different rhythms, but the underlying principles are the same.
That's it. The tools are the same. Salary, dividends, expenses, timing, but how you apply them depends on the business model. For Sarah, the priority was consistency. For James, the priority was stability. Both needed structure, but they used it differently.
Before we wrap up this part, let's highlight the key lesson for listeners.
The lesson is simple. Your tax strategy must match your business rhythm. If your business is steady, your approach should reflect that. If your business is volatile, your strategy must absorb that volatility. There is no single perfect number or structure for every director, but there is a perfect structure for your situation. You just need to build it intentionally.
Well said. And now that we've explored real-world examples, part 3 is going to take us into the long-term side, isn't it?
Yes, part 3 is all about what directors should think about beyond this year. Reserves, pensions, corporation tax timing, long-term strategy, and the habits that separate stressed directors from calm, confident ones. So if you're listening and using separate audio files, this is a natural place to pause before you move into the final part of today's episode.
And with that, this brings us to the end of part 2. Join us in the next section as we step into the bigger picture.
We'll see you in part 3.
Welcome to part 3 of our Director's Business Tax Planning episode. If you've listened through parts 1 and 2, you'll know we've covered a lot already. Part 1 gave you the foundation, salary, dividends, expenses, and timing, and Part 2 brought those ideas to life through 2 real-world case studies. Now in Part 3, we're going deeper into the long-term side of director planning. This is where directors stop reacting and start leading their financial strategy with confidence.
And this is where everything suddenly clicks for a lot of people. Once they understand the basics and see how it applies in real life, the long-term planning part becomes the missing piece that ties it all together.
Exactly. Most directors start off thinking month to month. They look at their bank balance, they look at what's due, and they make a quick decision. But real tax planning, the kind that actually reduces stress and helps you build a strong business, happens when you lift your eyes from the month ahead and look at the next 2-3 years.
So what's the first step in thinking long-term?
The first step is understanding your business rhythm. Every business has one. It doesn't matter if you're in design, construction, coaching, trades, digital marketing, e-commerce. There's always a pattern. In Sarah's business, her rhythm was seasonal. Peaks in spring and autumn, slower months in December and August. In James's business, the rhythm was project-based. Long stretches of costs followed by lump sum payments. Once directors recognize their rhythm, they stop guessing and start planning.
And the rhythm dictates how cautious or adventurous your tax strategy can be.
Exactly. If you have predictable income, you can push more into structured dividends or even pension contributions. If you have unpredictable income, you need a more conservative approach, leaving more money in reserves and paying dividends only when you're certain the numbers support them.
You mentioned reserves in part 2. Let's talk more about that because reserves are one of the strongest tools directors have, yet many ignore them.
Yes, reserves are essential. A company without reserves is fragile. Everything becomes stressful. VAT bills, corporation tax, equipment repairs, quiet months, you name it. I often tell directors, the moment you build reserves, you instantly feel calmer. Reserves give you options.
What does a good reserve look like?
For most small businesses, the baseline is 3 months of operating costs in the company. Some keep more, some keep less, but 3 months is enough to absorb most short-term issues. And here's the important part. A reserve doesn't mean you're hoarding cash. It means you're giving the business breathing space so you can make smarter tax and investment decisions.
So reserves aren't dead money, they're strategic money.
Exactly. With reserves, you can delay dividends to a better tax year, cover VAT or corporation tax without panic, invest in equipment or training at the right moment, ride out slow months without lowering your salary. It's one of the simplest forms of long-term tax planning.
Let's move on to corporation tax timing because directors often misunderstand the 9-month rule.
Yes, this one is important. Corporation tax is due 9 months after your financial year end, but if you wait until the end of the year to work out what you owe, you're already behind. The smart approach is to forecast your corporation tax throughout the year. If your year end is December, your tax is due in October. That gives you 10 months of visibility. And if you track profit quarterly, even at a basic level, you avoid the big unexpected tax bill that catches people off guard.
And you avoid the trap of taking money out before the tax has been set aside.
Exactly. Both Sarah and James set aside a proportion of profit each month, around 19 to 21% depending on their margins. And by the time the tax payment came, everything was ready. That's long-term planning without any complicated tools.
Let's talk about investments in the business. Laptops, cars, equipment, training. Where does that fit into long-term strategy?
It fits in naturally. There's a misconception that tax planning is only about taking money out of the business,
But for many directors, the smartest move is actually putting money into the business. The right equipment, the right software, or the right training. The rule of thumb is simple. If it genuinely supports the business or your ability to run it, it's worth considering. Equipment spreads its value over several years. Training increases revenue potential. Software increases efficiency. All of these shape the long-term direction of your company and influence your tax position.
You mentioned pensions earlier. We need to talk about that because directors often hear it's tax efficient but don't understand why.
Yes, pensions are one of the most powerful tools directors have, and so many leave them until it's almost too late. When your company contributes to your pension, it's an allowable business expense. That means it reduces your company's profit, it reduces your corporation tax, and the contribution goes into your pension tax-free. If your company is in a strong cash position, director pension planning becomes an incredibly efficient strategy. We'll cover that fully in its own dedicated episode.
And the flexibility helps too, doesn't it? Directors can contribute more in good years and less in quiet years.
Exactly. That flexibility is what makes pensions so valuable for directors specifically. It lets you adapt your long-term planning to your business rhythm.
Let's touch on bookkeeping and accountant relationships because this is something directors underestimate.
Yes, this is a big one. Some directors think accountants are only for filing returns, but the truth is your accountant is part of your long-term tax strategy. Even simple quarterly check-ins can transform your decision-making. When directors don't look at their numbers until the end of the year, everything becomes reactive. But when directors check in regularly, they understand their profit, predict their tax, take safe dividends, build proper reserves, and avoid panic moments. You don't need weekly meetings. You just need a clear structure and someone who helps you stay ahead.
So let's bring all this together. If a director listening right now wants to start long-term planning, what's the first practical step they can take this week?
Start by mapping 3 simple things: your quiet months, your busy months, and your fixed commitments. Once you see those clearly, you'll instantly understand your business rhythm. Then set your salary. Then set your dividend review dates. Quarterly works for most people. Then build an initial reserve, even if it's small. These 4 steps alone transform your tax planning and calm your financial stress.
And the beauty is that none of this requires complicated financial knowledge. It's just structure and consistency.
Exactly. Directors who plan ahead have more peace of mind, make better decisions, and grow their businesses more sustainably. This entire episode has been about giving directors clarity that's practical and accessible.
Before we close, let's recap the whole episode for listeners.
Good idea. In part 1, we covered the core building blocks: salary, dividends, allowable expenses, and understanding the importance of timing. In part 2, we walked through 2 real-world case studies showing how those principles apply differently in service-based and trade-based businesses. And in part 3, we focused on long-term strategy, reserves, corporation tax forecasting, pensions, investments, and building habits that support confidence and growth.
And the key message throughout has been that directors don't need clever tricks. They need clarity, consistency, and a structure that matches their business rhythm.
Exactly. And if you're listening and you'd like help building your own director's tax strategy, you can visit smartaiaccounting.com and book clarity. We upload new episodes every Friday, so make sure you subscribe if you haven't already.
Thanks for joining us for this first episode of the series. We've got so much more coming. Director pensions, home office strategies, company assets, and tax-efficient director